In one go.
Hello everyone, I'm delighted to welcome you to the first open seminar for the current semester of the Center for Good Governance. It's a pleasure to have with us here distinguished guests. I will just attempt to present our moderator, Professor Zenios. It's a challenge to find one or two sentences to make a brief introduction about the moderator of the event.
One sentence.
Even more challenging. Professor Zenios has graduated from the most esteemed universities. He has an outstanding career as an academic, and he's currently professor in finance at the University of Cyprus. You made this very difficult to get one sentence, but I'm still in the one sentence. And today he will be moderating an event that focuses on the governance of financial institutions within the European Banking Union. It's a very topical issue. I will pass on the floor to Professor Zenios, and then say what I have in mind. It's okay. Please.
Excellent sentence. Thank you. Brief to the point, and the audience is here to listen to our speakers. We don't get to say who the speakers are, but I think the audience today wants to hear what the speakers have to say, not who they are. I think it's a challenge. So first, let me congratulate the Institute for organizing this event, and I want to take two sentences. Why this is an important topic? We thought when the Soviet Union collapsed that the free markets reigned supreme, and therefore free markets self-regulate, and we don't need regulations. But we realized early on, especially 2011, 2008, 2013 cycles, that the markets need to be regulated. And actually there is an increasing realization that there are more and more demands on the state, like healthcare, managing the knowledge society, managing the financial system. So the issue of regulation is becoming increasingly important. And the important question we are going to ask today is who is regulating the regulators? And what is the purpose of regulating the regulator? What are the goals of regulating the regulators? Now, of course, we have a distinguished panel relating to the financial regulation, but it's important to understand that this is a very big question that we are going to deal with. So, a couple of sentences for our speakers. We have Professor Eleni-Louri-Dendrinou, who had a long and distinguished career in academia, and we are very sorry, as academics are sorry to see our colleagues leaving, but also very proud and happy when we see colleagues with distinguished academic careers moving into the policy world. So Professor Dendrinou, after a long career at the Athens University of Economic and Business, where she's still a professor emerita, she served as a deputy governor of the Bank of Greece for 6 years, and she's currently serving as a member of the appeal panel of the Single Resolution Board of the European Banks in Brussels. This is one of the important pillars of regulation we are going to hear about today. There are many sentences about her career and the papers she wrote, but after the one sentence introduction by Adonis, let me say by one sentence introduction, we have a speaker who understands the theory and has been in the practice. So we look forward to her presentation. Then we also have with us Mr. Marinos Lambrianides, who's had a long career with the Central Bank of Cyprus. And most importantly, Marinos' background is in international trade and finance, graduate degrees. Most importantly, at the Central Bank of Cyprus, he has been in charge of the newly established risk management section that gradually developed into risk and compliance department. And this again highlights the importance that societies have been attached to the risk management, the institutions have evolved the appropriate structures. And part of the discussion today is to see how do these structures evolve? Who makes these decisions? Who identifies those structures? Now, with Marinos, you are going to allow me to say a second sentence because he's been a high school friend of mine. He was the tallest student in the class. I was tall, but I was second. And I was not surprised to see that he served as the president of the basketball referees committee. So among other things, we have high expectations for Marinos. He was a very good student, but he did that as expected. So the way I'm going to structure it, Marinos has a background presentation about the banking union and the supervisory mechanism and how our central bank fits in. We have to respect, we have to be aware, we have to respect the fact that he's working for a central bank. So he may be a little bit restricted of what he can say, what he cannot say. Some of my students at the back, feel free to ask any question you want. But don't be surprised if he cannot say too much because there are restrictions. And so Marinos will give us the introduction first, a very good background, and then Mrs. Dendrinou will give us the Louri-Dendrinou, some of the current developments at the European level, and then we'll open the floor to discussion. So Marinos, thanks very much.
Thank you very much, Stefan. I remember back in 1976, 77, that was 46 years ago, when we were playing together at the open court in the Principiant Gymnasium basketball. Yes. Of course, I was taller then as well. And then I remember back in 2001, when we were thinking at the Central Bank of Cyprus to establish a risk management unit, and we visited you at your offices in Lambrianides, because you are an expert on risk management, to give us advice about how to set up the unit within the bank. Now that unit, with your advice, has evolved into the risk management unit and the compliance department now at the Central Bank of Cyprus. Okay. I would like also to thank EIMF for inviting the government of the Central Bank of Cyprus to speak at this event. Unfortunately, the governor is traveling. He's now, I think, at Marrakesh, where the IMF World Bank meetings, annual meetings taking place. Okay. The subject of my presentation is governance structure of the supervision and regulatory functions within the European Union. I will move to the next slide. If I may give you an outline of the presentation, I separated it into four sections. The first section will cover the European Banking Union and the relevant EU institutions. The second, the single supervision mechanism. And then we will talk about the Central Bank of Cyprus as a national competent authority. And the fourth section will cover the evolution of supervision in CGG in terms of organizational setup over the last decade, especially after the events that occurred, the cataclysmic events of 2013. So let's cover the first subject, the European Banking Union and relevant EU institutions. I mean, what triggered this union? It all started back in July 1990, where it was obvious that we needed a complete freedom for capital transactions, increased cooperation between central banks, free use of the European currency unit, is the forerunner of the euro, and the need for push for more economic convergence. The stage two started in 1994 concerned the establishment of the European Monetary Institute, a ban on the granting of central bank credit, which was a very important thing, increased coordination of monetary policies, strengthening of economic convergence, process leading to the independence of the national central banks to be completed before the establishment of the European system of central banks. Within that period, I think it was in 1st of June 1994, the European Central Bank was set up, and they started operations on the 1st of June or 1st of January of 1999 with the introduction of the euro in digital form. So the stage 3 started in 1999 with the irrevocable fixing of conversion rates, introduction of the euro in digital form, the conduct of the single monetary policy by the European system of central banks. And today, we have currently 27 members of the European Union. 20 of them are using the euro, and 7 countries are not using it. This map depicts the countries that actually using the euro, shaded in orange, and the other countries here are not using the euro, but most of them, they have pegged their currencies to the euro. So, let's go back again. What was triggered the creation of the European Banking Union? The need for better regulation and supervision of the EU financial sector, especially after the financial crisis of 2008 and the subsequent sovereign crisis in the euro area. We all remember what happened with Greece back in the period of 2010 and 2012. It became clear that especially monetary unions such as the euro area, problems caused by close links between public sector finances and the banking sector can easily spill over national borders and cause financial distress in other EU countries. Euro area countries decided to pursue and deepen integration of their banking systems. The European Banking Union was created in 2014 as a key component of the EU's economic and monetary union. All Euro area member states are part of it, and non-Euro area EU member states may join by closely cooperating with the European Central Bank. Also, significant progress has been made on the EU Common Rule Book, which is run by the European Banking Authority, and establishment of a new European architecture for supervision and resolution. What were the objectives of the Union? To ensure that banks are robust and able to withstand any financial crisis. Non-viable banks are resolved without recourse to taxpayers' money and with minimal impact on the real economy. Market fragmentation to be reduced by harmonized financial sector rules. And what were the pillars? The pillars of the banking union were the single supervisory mechanism, the single resolution mechanism, and to be completed, establishment of the European Deposit Insurance Scheme, and I know that they are in very good, have very good progress on that, and by 2025 there will be something concrete in terms of the European Deposit Insurance Scheme as well. What are the institutions that are part of the architecture? The European Banking Authority, of course the European Central Bank, the Single Resolution Board, and I'm not sure about the European Commission that is there. I thought that there is no direct relation in terms of supervision by the European Commission. So let's move to the single supervision mechanism. The role, of course, of the European Central Bank, the most important pillar in the architecture. The European Central Bank is an independent institution overseeing banking supervision from a European perspective by establishing a common approach to day-to-day supervision, taking harmonized supervisory actions and corrective measures, and ensuring the consistent application of regulations and supervisory policies. which countries participate. As we said, all euro area countries participate automatically in European banking supervision. For those EU countries that are not participating automatically, the ECB and the relevant national supervision may set out in a memorandum of understanding in terms of how they cooperate on supervisory matters. The ECB directly supervises 111 significant banks. This is data as at end of September 2023 from all participating countries. At any time, the ECB can decide to directly supervise any of the banks that are not considered significant. What does banking supervision entail? The ECB has the authority to conduct supervisory reviews, on-site inspections and investigations, grant or withdraw banking licenses, assess banks' acquisition and disposal of qualifying holdings, ensure compliance with EU prudential rules, and set high capital requirements, so-called buffers, in order to counter any financial risks. So, how the Central Bank of Cyprus fits within this architecture as a national competent authority? Okay, the Central Bank of Cyprus is governed by the Central Bank of Cyprus Law 2002. It is an integral part of the European system of central banks and acts within the fields of competence of the system in accordance with the guidelines and instructions of the European Central Bank. As an integral part of the European system of central banks, the governor is a member of the European Central Bank, Governing Council and General Council, which are the main decision-making bodies of the ECB. Similarly, employees of the CGG participate to ECB committees, working groups, and other committee infrastructure and task forces. What is the mission of the CGC? The primary objective of the CGC is to ensure price stability. And without prejudice to its primary objective, the CGC supports the general economic policy of the government. To contribute as an integral part of the ECB in the formulation and implementation of the European Community's monetary policy. With its central banking and other functions, it's also responsible for the national, is also acting as a national competent supervisory authority, a national resolution authority, and national macroprudential authority, which means macroprudential oversight of the financial system with a view to ensuring the stability of the financial system as a whole. So, what were the milestones in relation to supervision? We started back in 2008 when Cyprus joined the euro area. Since then, there are two standing facilities providing and absorbing government liquidity, the marginal lending facility and the deposit facility, respectively, while the minimum reserve account is the only operational account of banks within the CGC. Single supervisory mechanism as of November 2014. When the SSM came into force, the supervision of important financial institutions was entrusted to the ECB. The ECB is now responsible for the direct prudential supervision of important credit institutions established in the euro area member states. The direct prudential supervision of other financial institutions established in the euro area continues to be exercised by the national supervisory authorities under the guidelines and instructions of the ECB. The supervision of branches of credit institutions from third countries remains the exclusive competence of the national supervisory authority, in the case of Cyprus, to the CGC. So, what are the main functions in relation to supervision and oversight within the central bank? licensing and supervision of credit institutions, which is carried out in accordance with the provisions of the Business of Credit Institutions law. Since the inception of the single supervisory mechanism in 2014, plays an important part of the supervisory functions of the CDC, and this part was assigned to the European Central Bank. Money laundering activities, though, according to section 59 of the Prevention and Suppression of Money Laundering Activities law, the CDC is a competent authority for the enforcement of the provisions of the AML legislation regarding financial business on credit payment and electronic money institutions. In 2013, the CDC issued a fourth version of the Directive of the Prevention of Money Laundering and Terrorist Financing, which sets out the procedures and control systems that all credit institutions should implement for the effective prevention of money laundering and terrorist financing in order to achieve full compliance with the requirements of the law. An amendment to the directive was issued in April 2016, and I think that this directive is still in force. The CDC also issued a series of guidelines to credit institutions on key thematic areas, such as customer identification procedures and due diligence measures, ongoing monitoring of accounts and transactions for politically exposed persons, fraudulent tax crimes, risk management systems for the prevention and suppression of money laundering and terrorism financing. CDC is also a competent licensing and supervisory authority for payment institutions, electronic money institutions, something that is going very strong lately. I mean, we have many applications with regards to electronic, for the establishment of electronic money institutions. We wrote a change businesses and credit acquiring and credit services companies operating in Cyprus. So the supervision division within the bank is separated into four departments. The first department, and this is called the significant and less significant supervised institutions. It supervises major banks in a joint effort with the joint supervisory teams with the ECB. The JSTs, joint supervisory teams, main responsibility is safeguarding compliance with EU micro-prudential rules. It supervises less significant supervised institutions and which are also supervised indirectly by the European Central Bank. The second department is the Supervisory Strategy and On-Site Inspection Department. This department identifies risk and monitor changes in the overall risk environment of the banking system. It is within this department that we have accommodated the crisis management unit. It's also responsible for on-site inspections, which are planned and staffed in close cooperation between the ECB and the LCAs. It supports joint supervisory teams in their supervisory activities, the teams that belong to this department, and cooperates with other relevant CDC divisions, like the Financial Stability Department. The third department is the Supervisory Approvals Department. This is a department that deals with licensing of credit institutions, electronic money institutions, payment institutions in cooperation with the relevant ECB departments, and also performs fit and proper assessment of proposed members for the management bodies. The fourth department is the Supervisory Governance Department. The department monitors and formulates positions and opinions on the CDC on the various ongoing regulatory issues stemming either from the ECB or other institutions like the European Banking Authority, the European Commission, etc. So this department, the anti-money laundering and combating the financing of terrorism department, belongs to another division. Nevertheless, it has to do with matters related to supervision, because they actively supervise the EMIs and the PIs, electronic money institutions and the payment institutions. How are we with time? Okay.
Okay.
Okay. Okay. So, what is the objective?
How much more time we need?
I will say a few words about the microprudential policies, and I will compare them with the macroprudential policies, which is a different structure. Objectives: the safety and soundness of individual entities and the stability of the system as a whole. The risk factors considered by microprudential authorities include financial risks associated to capital liquidity and the funding position of the entity, as well as non-financial risks related to information communication technology risks or risks stemming from weak or flawed governance or a poor or unrealistic business models. Such instruments are part of the Basel III framework as implemented in the EU by the Credit Risk Regulation, CRD 4. So, risks addressed by macroprudential policies. First and foremost, the credit risk. The risk that the borrower will not be able to repay the loan granted to him, here by the bank. Such non-repayment causes a loss for the bank. For example, a reduction in its asset must be matched by a reduction in its capital. Market risk concerns potential losses arising from movements in market prices. Market risk exposures are largely but not exclusively due to trading activities, and drivers include exchange rates, interest rates, or credit spreads. Operational risk is the risk of negative financial, business, or reputational impacts resulting from inadequate or failed internal governance and business processes, people, systems, or from external events. Interest rate risk, of course, is the risk to a bank's capital and earnings arising from adverse movements in interest rates that affect the institution's banking group positions. And liquidity and funding risk, it concerns a potential situation whereby many depositors and investors withdraw funds they have provided to the bank, leaving the bank short of funds and forcing it to sell assets quickly, often at a great cost. Now, what are the microprudential policies which carried out by the Financial Stability Department, which again belongs to different divisions, not to the Supervision division. The main objective of macroprudential, is to contribute to the stability of the financial system as a whole, thereby safeguarding the financial system against the buildup of systemic risk. Therefore, its focus is on the entities and their interactions as a whole. CDC monitors at least 4 broad categories of vulnerabilities in the system: mispricing of risk, over-leveraging, maturity mismatch, and liquidity transformation and excess interconnectedness and complexity. These vulnerabilities can be addressed by the following macroprudential measures. Capital-based measures. These target banks' capital and provisioning requirements to increase the overall resilience of the banking sector by mitigating the buildup of risk exposures. By providing firms with sufficient buffers, instruments such as the counter-cyclical capital buffer, which was we have announced something I think 2 days ago, as a CDC, should counter the risk of rapidly unwinding positions during contractionary phases or due to excessive interconnectedness. Asset-based measures, they impose quantitative restrictions on positions. For example, caps on loan-to-value and loan-to-income ratios or large exposure restrictions which may lead to under-diversification. And liquidity-based instruments containing banks' vulnerability stemming from overexposure to short-term financing, maturity mismatches, the lack of liquidity assets. So, we have the events of 2013 and the events that preceded the crisis of 2013. This is the organizational structure of the Central Bank of Cyprus and the supervision functions back in 2012. As you can see, we had only two responsible departments for issues related to supervision. We have, of course, the events of 2013. We have the turmoil in the markets, on the sovereign markets in 2011 and 2012. And then I remember I was head of HR. The central bank brought in a well-known German firm, Roland Berger, and we came up with some very important changes that for me changed the landscape of how the supervisory function of the central bank was implemented and executed. So this is the arrangement after the very important change in the structure of the Central Bank of Cyprus in terms of supervision in 2017. So we have a supervision division, we have three separate departments, and within each department we made special arrangements for 6 different sections to operate for specialized issues. And this is the final slide. This is the picture today with the Central Bank of Cyprus supervisory function. We have today a supervision division and 4 different separate, as explained before, sections and departments. And each department has at least 1 section, 3 of them has 2 sections. And also some supervisory responsibilities lie with this department here. It's the AML department because we have some correlation in terms of AML, CFT supervision with the prudential supervision of the EMI and PI entities. That's for me. Thank you for listening.
Thank you.
I hope that was not very but it has a descriptive nature, so it was unavoidable.
Okay, thank you, Marinos. No, I think it was very useful, very well done, and an excellent background, both for our central bank and for the regulatory system in Europe, how it evolved. And it set the stage very nicely for Mrs. Louri-Dendrinou to give us her presentation.
So, well, I was sure that the central bank should have prepared a very nice and detailed introduction about the financial architecture of supervision. So my slides are much, less organized, not organized in a sense, but it's much more brief. And the presentation is much more brief. So, as you heard before, what's the European Banking Union? Why? Because of the crisis of 2008-2010, which was, a crisis which came at a time when euro area was still at the very initial stage and was certainly unprepared for this size of crisis. So because of the crisis, we had the EU heads of state and government committing to a banking union in 2012. And then since then, substantial progress has been made by introducing this CRD4 directive, which is the backbone of supervision, and which is into force since 2014, and on which is based the single supervisory mechanism that Mr. Lambrianides talked about before. And well, on top of the single supervisory mechanism, which is based in Frankfurt and is known as SSM, well, this is the organization which, together with the national supervisory authorities, supervises the banks of each European country. Of course, not all banks, the very significant banks, there's 111 banks. But still, if you think the number is small, 111 banks only, it's more than 80% of banking assets in the Euro area. So it's really the significant banks that are supervised there. So what they thought by introducing this organization was, hang on, this organization is going to impose, to take some decisions with referring to the supervised entities, to the supervised banks. So a very significant decision is you have to increase your capital by, I don't know, 5 billion in the next 2 months. So why? Because we think you are more risky than you suggest to us. So, this is our decision. So this is a decision which is costly for the bank. So the bank, what can the bank do? Of course, we are in Europe, we have democracy, so it's not that a decision has to come from an upper level and you have to obey without being able to express some kind of doubts about the correctness of the decision. So what do you do? What have they thought of? As these decisions are going to impact banks, for sure, maybe funds, investment funds, investors, we have to foresee some kind of institution where, on the first level, these appeals against decisions of this organization can go at the first level. And then if they are not happy, if banks or funds or citizens are not happy with the appeal, the answer to their appeal, then they can go to the European Court of Justice, etc. So, and we're talking about decisions which affect, which refer to large amounts of money, and they may incur a big cost. So, in the case of the single supervisory mechanism, within the organization, there is this board of appeal. The board of appeal consists of 5 people which are selected by different member countries by the ECB, and they are independent. They have an independent meaning they have an independent independent term at this board of appeal, and which is 5 years, renewable once only, and they can receive the appeals that and the questions probably which are phrased as appeals, which the supervised entities may have, and there is a first step which can be faster, and if they are happy with the answer, it's okay. If they are not happy, they can proceed to the Court of Justice, etc. So, single supervisory mechanism launched in 2014, and together with it, there is this board of appeal, a 5-people board which receives appeals, usually by banks, complaining about some decision the SSM has taken, and which maybe is very demanding on them, or which they consider to be wrong. Okay, then, so the first thing which takes place with respect to the banking union is the installation of the SSM in 2014. Then in 2015, we have the second pillar, which comes into being, which is based on this Bank Recovery and Resolution Directive, the BRRD, and which creates the single resolution mechanism. So what is resolution? Why is it the second pillar? Because, well, supervision is one thing. So you supervise a bank, and you see that the bank is healthy and has the capital required and the liquidity required, etc. That's fine. You supervise another bank, and then the bank has not the capital required because it has lots of losses, because it has lots of non-performing loans, etc. And you ask the bank to increase the capital. The bank, and you give it a kind of timely lead. Within the next 2 months, you have to increase the capital by 2 billion, for instance, or 10 billion, depending on the bank. So then the bank cannot find the capital because the market is suspicious that probably the not acting enough. So 2 months go by, the bank comes and says, sorry, I cannot find the capital. And then maybe you give it another month, but then at the end of the third month, if the capital is not there, or if the liquidity is not there, what do you do as supervisor? The supervisor is responsible, as you heard before, to give the license, to provide the license, and to withdraw the license. So if the criteria is not satisfied, the supervisor has to withdraw the license. But what does it mean to withdraw the license? I mean, a bank has depositors, a bank has trust, a bank affects financial stability in the country. So what happens next? You withdraw the license, and then what? What happens to the depositors? What happens to the borrowers? What happens to all the borrowers? So what you have to do as a second step is to think of the resolution strategy. So the second pillar is resolution. We have supervision, which is symmetric and which is the same for all important banks in the euro area. But then if something goes wrong, then you have organized the resolution. So the resolution is the second pillar. And so the BRRD creates the single resolution mechanism. And resolution has to take place according to the same principles in every euro area country. So the single resolution mechanism consists of the single resolution board, which is the organization like the SSM, which discusses with banks their resolution plans. Because the new idea after the crisis is that the banks have to prepare, the commercial banks have to prepare, the supervised banks, they have to prepare resolution plans to make sure that they know in case they cannot continue functioning anymore, what will happen. So they have to prepare these resolution plans together with the SRB. And of course, if you have to resolve a bank, what do you need? You need money. I mean, somebody has to pay, either the depositors or the bondholders of the bank. So because you need money to be credible that you can perform a resolution without affecting the taxpayer, what do? You create a fund as well. So together with the Single Resolution Board, the Single Resolution Fund, the SRF, was created. So what is the SRF, the fund? Every bank which is supervised by the SSM and then will be resolved by the SRB in case of emergency, has to pay contributions to the SRF every year, which are usually depending on the amount of deposits the bank has. So, I mean, the SRF is, although it started, so recently, I was reading yesterday, it already has around 70 billion euro as, the safe thing there to be able to finance a resolution, if a resolution has to take place. So, single resolution mechanism, as Mr. Lambrianides said before, the mission is to ensure that in case there is an emergency and the bank is not safe anymore and has to close down, So then we can achieve an orderly resolution of this bank with as little impact as possible on the real economy and on the public finances. Public finances mean you and me, I mean the taxpayer. And this resolution follow-up, I mean the plans, the resolution plans and all that, is done in cooperation, the SRB with the national resolution authorities. The national resolution authorities are usually based, it's like a division or department in a central bank. In every member state, there is now, after 2015, there is the FSC, as the same Greek, there is a department of resolution. And this department cooperates, as there is a department of supervision, and it cooperates with the SSM. The Department of Resolution cooperates with the SRB in order to have banks ready and make sure banks have acquired the liabilities required, because depending on their business model, on their riskiness, etc., the banks have to acquire what's called minimum required eligible liabilities to be there available. I mean, they are bonds, but riskier bonds than other bonds, because they are the first to be used in case funds are going to be needed for resolution. So you have this structure for resolution, and I mean, one question you may have, no, maybe I have to finish. And again, in the same spirit as with the SSM and the Board of Appeal, another Board of Appeal was created here in the organization, which is independent. It belongs to the organization, but it's independent. It's 5 independent people with a limited term, selected not by the organization. These people here in the appeal panel, they are selected by the Commission, the European Commission. So they are not affected at all by the organization. And the Board of Appeal of the SSM, they are selected by the ECB. Appeals against SRB's decisions can be directed as a first. The first call should be to the appeal panel of the SRB. So again, the thinking is, the logic is the same. It's a democracy. We take decisions which may cost billions to banks, to shareholders, to all stakeholders. So if they have problems with the decisions of the organization, they have to have somewhere to appeal, because if there is no appeal panel, what can they do? They can go straight to the European Court of Justice if you have a big problem. But I mean, who can go to the European Court of Justice? So there has to be some kind of interim structure, some interim organization for people to be able to express, their complaints and to express their serious complaints, of course, and to express them in the form of an appeal against a decision of the organization. So appeals against the decisions of the SRB can be directed to the appeal panel of the SRB. And now you can ask me, the SRB is in existence since 2015. Have there been many resolutions? No, just 2. One was the Banco Popular, that was back in, I think it was 2019. And then in 2022, it was Sberbank subsidiaries, the Russian bank which had subsidiaries in 3 Euro area countries. It's Austria, Slovenia, and Croatia. And it was resolved because what happened there? Well, that's what happens always. People realized it was risky, and because of the sanctions against Russia, when Russia invaded Ukraine, then there was no liquidity. There was no. The mother institution could not provide liquidity. The depositors were afraid that something will happen to this Russian bank, and so they started withdrawing their deposits. So at a certain point, the banks, the three subsidiaries in the three member states, ran out of liquidity because depositors were afraid and they were withdrawing their deposits. So fortunately, there were very small institutions, small institutions by European standards. So in a sense, the problem was easily resolved. Banco Popular was a much larger bank, the Spanish bank. In this case, it was again a bank which had problems raising new capital. I mean, the Spanish banking sector, if you remember, after the big crisis in Europe, had lots of problems. I mean, Spain entered into an MOU with the way Greece entered and Ireland entered and Portugal entered with the other European member states and IMF, etc. I mean, because they had problems, the state had problems meeting its obligations. In Spain, they had a special problem with reference to the banking sector. The banking sector was very exposed, very much exposed. So Banco Popular lost the trust of the market. They couldn't find the capital required, and I mean, you have deposit withdrawals, and then of course you have the resolution, resolution usually takes place in a weekend because you want people. I mean, usually the resolution authority and the supervisory authority, they are in touch. So on a Friday afternoon, when the bank closes, when like 5 o'clock, the license is withdrawn from the supervision, and then a resolution takes over and tries by Sunday to have some kind of, next, situation, next functioning, properly functioning situation, which usually is either bridge bank, where you put a new, the creation of a bridge bank, where you put a new, head and a new governance, or you can have sale and purchase of assets, and this is what happened mainly in the case of Banco Popular, which was bought for like €1 by Santander. In a sense, it was absorbed by Santander because there was no other, buyer in the market interested in buying €1, absorbing it actually. So these are the two big resolution cases. Of course, there have been many other smaller resolutions, but because they were smaller, they were taken care by the national resolution authorities and not by the SRB. As Mr. Lambrianides said before, the third pillar of the banking union, which is missing, is the common deposit guarantee scheme, which has been discussed for a number of years. But for everybody to guarantee everybody's deposits, and of course this holds a lot for the German taxpayer or the Dutch taxpayer, who are usually the very conservative ones. Banks have to have a similar risk level. So at this point that we are discussing it, is the risk level similar? No. After all these years of having and applying the same, the same supervision and the same resolution method, etc., still non-performing loans in Greece are 8%, while the average in the euro area is 2%. So in a sense, we have 4 times greater credit risk than other countries, and of course, this is the average. I mean, in Germany, they have much less than 1%. So in a sense, until we reach this kind of agreement for a joint deposit guarantee scheme, we have to reach a similar risk level. So so there have to be conditions. It cannot come automatically. Once we reach these conditions, then we'll end up with a joint deposit guarantee scheme. I mean, it's not that we don't have some kind of joint deposit agreement. I mean, now there are some agreements that one national deposit guarantee scheme will lend to another, etc. There are these kind of agreements, but still we don't have, this common thing which would be really the third pillar. You want to ask something?
Yes. One question is, if everything happens within 2 days, in a weekend, so what's the use of the volume of the
It comes afterwards. You cannot.
If you have a resolution, then how are you going to challenge the results of the resolution? If the resolution starts, you destroy my reputation, the catastrophic events will happen, and then, okay, I'm going to challenge what I'm going to challenge.
Okay, you cannot stop. Once the supervisor has decided you are not worthy of having a license, this is done.
So I cannot challenge the most important decision of the regulator.
You can challenge it afterwards, and you can get some kind of remuneration, let's say, if your arguments are correct. But usually the supervisor is, in Greece, that I'm very experienced about, we had something like 13 resolutions of banks. We restructured the Greek banking sector between 2012 and 2014. And we didn't have any problems because, it's open. You have the auditors' reports open, everything is open, and you can see that this bank could not function anymore. So, but what you can do with respect to the resolution, what's happening now is the decisions do not refer to the resolution per se. The appeals do not refer to the resolution decision per se. They refer to the requirements by the SSM or the SRB to, have to increase your capital or to increase the minimum required eligible liabilities, the bonds available in case of resolution. And the bank thinks, we even have because I work at the appeal panel of the SRB, we even had an appeal by a central bank of a medium-sized country, which was against the decision of minimum required eligible liabilities for a commercial bank, saying that no, these were very few. The demand was very small, and they believed a higher requirement of eligible liabilities should have taken place. In this case, the appeal was dismissed, but then, usually, you don't. There have been appeals against the Banco Popular and their resolution, and they are now the European Court of Justice. But it's so well thought and so well documented, the decision to withdraw a license. For me, it's unbelievable for a Court of Justice to find out that, it has never happened before. I haven't seen it. It's so open and so clean that this bank cannot continue functioning, that I haven't seen any such decision being taken to the court and being approved.
Is there any success?
So can we let her speak and then we'll have a discussion?
Sure.
Yeah.
But no. Is there any success on what?
Yeah.
Appeals many. They ask for less capital because they are less risky and they bring all the documents. In our case at the appeal panel, they ask for, they ask for a lower amount of minimum required eligible liabilities because they believe they are not as risky as SRB thinks, for instance. And there have been many appeals which are, the least you can do is because we have, this appeal is like a mini Court of Justice. We have an appeal and then we ask SRB to answer. So there is a reply. And then the appellant can answer back. So we have what's called a rejoinder to the reply. And then once we have the rejoinder, the organization, the SRB, can provide a last response. So we have this thing, and then if they don't agree, we call them for a hearing. So we have a hearing, it's like a mini Court of Justice. We have the hearing, and it's the lawyers of the SRB and the lawyers of the bank, and we can hear the arguments. And if we are convinced, the case the decision can be remedied to the board for amendments or for changes, or if we're not convinced, the appeal is dismissed. So yes, there have been many cases. I mean, it's all open on the internet. There are sites. Okay, so this is the governance of the banking union and the governance of the independent organizations, the two at least existing now, and what's missing as a third pillar. So after that, I thought maybe it would be interesting if I had some slides about the Greek resolution. Well, that was a resolution, amazing wave of resolutions we had in Greece because of the crisis in 2012-14. As I said, we resolved the number 5 Greek, only 4 Greek banks now are there and are 92%, 95% of the market. All the rest, the number 5, our key bank, the number 6, Post Bank, etc., they were resolved and absorbed by the 4 systemic banks. So one idea is to provide some numbers and some, the way we proceed so that you see a proper resolution. Of course, I have to say that the Greek resolution wave took place in 2012 and 2014, in these 2 years. So it was before 2015. So it was not bail-in. The banks were not prepared for bail-in with resolution plans, etc. It was really bail-out. Bail-out means that the state pays for the capital missing and the deposits missing, and pays the systemic bank, which absorbs the bank, the failing bank, to take it and continue the critical functions. So I don't know, maybe we should stop here and take questions. Maybe I should proceed with the example of the Greek case. What do you want?
You don't have an example with bail-in in Greece.
There hasn't been any bail-in.
There hasn't been.
No. All the bailouts took place, 2012, 2014.
So maybe you can take a few more minutes and try to wrap it up and give us some.
So, maybe background why it was so. We had this huge wave of bank resolutions in Greece because the crisis was very deep. We lost quarter of our GDP, unemployment went up to 27%. Banks faced serious, huge losses. And of course, the banks could not, they had losses. And then, of course, they were afraid of lending more money to the market. And of course, that caused, it was a vicious circle that caused recession again. So it was really very chaotic, a chaotic time and a very difficult time for Greece. So we did not see that. So what happened with the banks? We did not see that. It's okay. What happened with the banks is that they lost something like between 2010 and 2015, they lost half the deposits. We had 240 billion deposits, like 1 GDP. Deposits are usually equivalent in an average country, are equivalent to 1 GDP. So in Greece, GDP was close to 230, deposits were 240 billion in 2010. 2015, they went down to 120. Imagine banks losing 120 billion deposits. And then at the same time, these deposits were not at the bank. These deposits were at the same time given as loans to firms, to mortgages, to even consumers. So at the same time, these people, they could not, because of the recession, they could not pay back their loans. So it was an impossible situation. They were losing deposits and then they could not, their loans were non-performing. So it was a very bad, vicious circle. And what in the beginning, banks thought it was just a liquidity problem. Give me some more liquidity, they were asking the central bank. And because our case liquidity pressure now because of the general situation. And they couldn't understand, but at the end of the day, that would turn out to be a solvency problem, which it turned. And financial stability, that I wanted to complement before to what Mr. Lambrianides said. The central bank, the main target of the central bank, the main goal of the central bank is in Europe, is price stability. Inflation not exceeding 2%. Every year. But the secondary goal is financial stability, because if you don't have a functioning financial market, then there is no growth, and there are all the other problems. So in this crisis, we decided, we had a banking sector which was expanding, and we decided we cannot save. I say we because I was at the central bank at that time and responsible for resolution. And we said, we cannot save everybody. There's no way we can do that. So we said, okay, let's see the capital needs of all the banks in the market because of all this crisis. And at the same time, let's see which banks are worthy of saving because they have a proper business model, because they have a proper governance, so we performed, in a sense, two assessments, a capital needs assessment and a viability assessment. These were done by foreign consultants, McKinsey. McKinsey and Wells, McKinsey and another one. So, with this crisis, we decided, and that was
Maybe if you can wrap up the strategy, skip the details of the system so we can have some discussion.
Yeah, okay.
Because I had a previous slide.
So the strategy was that for the 4 systemic banks which could be saved, the capital needs would be like 27 billion. For the restructuring of all the other banks, for the resolution of the other banks and the restructuring, we would need 17.5. And then, so that's 45 billion. And then we thought maybe, we haven't estimated things properly because you can imagine this estimation, it takes place during the crisis with a lot of pressure, time limits, etc. So we said, let's have a capital buffer of 5 billion in case we calculate something wrong. So at the end of the day, we came up with an amount of 50 billion, which was required by our, lenders. And we said in order to save the this is called the financial envelope. We said in order to save the banking sector, the financial sector, we have to have on top of everything else to provide us loans, 50 billion for the banking sector. So this is how we got the money to save the financial sector. Since then, I have some details here, how many institutions, 19 commercial banks, etc. Today we have not even half. We resolved, major Greek banks, agricultural Greek, Bank of Greece, Hellenic Post Bank, etc. And in Greece we have a small, in contrast to what we have in Cyprus, a cooperative sector which is vibrant and big. In Greece it's a small cooperative sector. At the height of its presence, it was like 2% of deposits. But there are many small banks in many areas, 19 small cooperatives all over Greece, which were kind of useful for the local, especially agricultural firms. But today we have only 4 actually, I think, and the 5th one is a Greek thing, which is now a commercial bank. So here I have some details about how the resolution was made, and of course, don't think that once we had a bank for resolution, Agricultural Bank of Greece, it was in August 2012. We had this big bank, the number 5 bank, Greek bank, many non-performing loans, huge capital losses. They tried to increase capital, nobody was willing to put in more capital. So we said, okay, but we have to withdraw the license, and then we have to do something with it. The depositors, this bank was very important. There were communities where there was only one branch of a bank, and this was an agricultural bank. So the taxpayer had to pay for the assets which were missing, and we transferred all the liabilities, which are the deposits basically, and the good assets, and the part which was missing from the assets, the NPLs, the non-performing loans basically, were paid by the taxpayer, so that we transferred a balance sheet which was equal, the two sides, and this was absorbed by one of the systemic banks. In the case of agricultural, it was absorbed by Marinos, which paid something, a minimal amount, but paid something. For the others, there was not even interest for paying even €1, like in the case of Santander and Banco Popular. So, we do not see. So here, there was a cost to see, but the costs were very close to the cost of what we had estimated. And in total, a resolution, because at the end of the day, for the four systemic banks, private sector came in, and the law which was created said, if the private sector puts 10% of the capital needs, then the management will stay private. So that happened. So we didn't need all 50 billion. At the end of the day, we needed like 42 billion. And but this 42 billion were added and are still in the Greek debt, in the Greek government debt. And this is a huge amount of debt which the taxpayer has undertaken. To conclude, that was the example. To conclude, the reform of euro area architecture has produced a more complete union, because when the crisis struck, then it was obvious we didn't have a proper banking union. Considerable progress has been made. Still, progress needs to be made about the common deposit guarantee. Common supervision and common resolution provide transparency and stability in the market, enhance financial stability in the financial market in Europe. It's also obvious that we need a capital markets union. We need to have a more active role from the capital market in financing, because you know that Europe is the opposite. It's like the other side of the States. In the States, 1/3 of corporate financing comes from banks, and 2/3 come from the capital market. In Europe, it's the other way around. It's only 1/3 comes from the capital market, and 2/3 come from banks. They are bank loans or bank-based bonds, etc. So, also the Greek banking system has undergone profound structural change. As I told you, we only have 4 banks, and there is a lot. 4 banks, what does it mean? Controlling 95% of the market. Oligopoly. And oligopoly, what does it mean? It means high prices for the consumer. And what is high prices for the consumer? In the case of the Greek consumer, it means low deposit rates. Deposit rate is like 1% now, 0.5%, something like that, and high lending rates, which is average 6%. So the spread between deposit and lending rates in Greece is 5%. It's amazing.
But it's still better than high.
How much is here?
Lately it's improving, but it's not 5%, but it's higher than the previous periods, definitely.
Greece is since if you have such an oligopolistic sector. But of course, on the other hand,
deposit rates and lending rates very, very slow.
But if one asks why didn't you know that by making the sector so concentrated, you would create oligopoly power? Yes, of course we knew. But at that moment, what's important was the financial stability part. Without consolidating the banks, we could not have financial stability. So now we try, the central bank is trying to encourage a 5th bank based on Attica Bank, smaller, and few other smaller banks. And of course, what will be very important will be to have foreign banks coming and opening subsidiaries if we are interested in the Greek market. Of course, before the crisis, we had 2 big French banks, Société Générale and Crédit Agricole. They just left. They sold and they left because they were afraid that the crisis would create negative reputation effects for their brand name. So they left in the beginning of the crisis. So foreign banks is a good thing, but on the other hand, it's also, it can be quite complicated if crisis comes. So maybe we take questions?
Yes. Okay, thank you very much. I think it was a tour de force of what's happening in Europe, the banking union, the supervisory system. We learned a lot about this. I think I can speak for everybody in the audience that it was very, very useful and very interesting. Especially I can speak on behalf of my students. They learn lots of new stuff. But I can also speak about myself. I learned some new stuff. So let's move our chairs to the center to have a panel discussion. So let's take some questions from the audience. I have a couple of questions, but I will leave them for them. So from the audience, yes, and please identify yourselves. Yes. Not just your name. You are a student in my class, no.
No,
give us your background. Yes, to be your home. Okay. Okay, great.
Yes, and my question was very interesting about this discussion on bailout. And I was curious because you spoke about such big amounts, 42 billion, 50 billion, so I was like wondering from where this money are coming to save banks. What is happening? What is the mechanism?
the banks have to issue bonds in the market. And because the market knows that these are bonds which are going to be used at the first instance of risk, of resolution risk, the market asks for a very high yield. So these bonds are, I mean, the Greek banks issue bonds for the MRL, and they pay 7-8%. They are very expensive because they are very risky, of course. So the money comes from the market, and you know, it's the market takes its risks, its funds, its insurance. I mean, whoever is in the market can buy these bonds, knowing that the high return is related to higher risk. And so they tap the same market as everybody.
And what is the expectation this debt from the big side to be paid? Like the time frame? The 42 billion?
The bonds.
Yes.
I don't know if I said the number, which is not, I mean, the number, the amount of MRLs is, you know, depends on the bank. It can be like, I don't know, 5 billion for Alpha, I'm not sure. It can be.
I think it depends on the risk-weighted assets.
On the risk-weighted assets, yes, it's a percentage.
So there is a certain percentage that is going to be, has to be met usually they provide enough time in order for the bank to secure these funds, the MRL funds as we call them.
And still...
Indeed, their interest rates are much higher than the other funding of the bank because it's earmarked for special purposes, and that is in case the bank enters into a resolution procedure.
But on the other hand, the market is, I mean, the interest rates are low in general, or were low. So, you know, finding 8% is kind of, you know, an interesting prospect for some kind of fund management. So it's not that they cannot find, they find the funds if they pay the yields required. But of course, because I mean, we're talking about, you know, 111 banks, and the amount of money is very large. There is a time, I mean, it's organized stepwise in time. So it's not that they have tomorrow to find all the money required, all the liabilities, all the MRL required. They have a prospect every year to gather a certain amount towards a final target. There's a final target, and every year they have to, you know, provide, or if they cannot, they have to excuse why they cannot, and then maybe, you know, step up the following year. So it's not required tomorrow. Mm-hmm. Okay.
I think another interesting element is that There are funding costs with regards to MREL. It depends also on their rating. For example, the Bank of Cyprus and the Hellenic Bank were upgraded 2 weeks ago. That means that they will be able, both banks, to secure funds at more competitive rates.
Okay, yes. Yes.
I'm Professor Eleni-Louri. Thank you very much, Mr. Lambrianides, and Professor Louri-Dendrinou. I think your analysis is important because you bring a very strong economic, you have a very strong economic interpretation to regulation, but we are also celebrating what good governance means. So if you allow me, I'd like to make 2 points. The first is there's a great emphasis, and Mark Carney, the ex-governor of the Bank of England, has been very much pushing for a degrowth, if you wish, approach to the economic positioning of the financial services and the economies at large, promoting the value of values. And I am very interested to hear from you. I'm delighted that you are representing Mr. Lambrianides, the human resource management perspective, because as a professor in business and management, I care a lot, and I work for 4 years with the chief internal auditor of a major financial corporation who has been receiving hefty fines year on year after the financial crisis, and is still unable to arrest conduct risk. Where does all this regulation, and I'm excited with your prospect of micro-prudential policies, actually captivating such a risk, which I didn't hear you mention?
Yes, yes. Very good question. My Carly's book on values, we are discussing about the system, the way we understand it, the way we teach to our students, but there are other dimensions where governance is important. So,
yeah, I mean, other dimensions, I haven't really got the final question. Because
it was an invitation towards a reflexive.
Okay, so there is an answer.
Let me add something to this, because I had a quote I was going to leave at there, but you passed the ball to me. This is from the OECD publication, Guidelines on Good Governance. And they talk about the challenges, the frictions regulators face in a more general context, all kinds of regulators, but also refers to the central bank. So let me read something very brief. The challenges: to be less intrusive but more effective, to be kinder and gentler, but don't let the bastards get away with anything, which was a debate you had earlier. Like, can I appeal? Of course you can appeal, but you have been resolved, right? This is the stress. And process things quicker, but be more careful next time. Like Cyprus will learn something. And now to come to your question, deal with important issues, but do not stray outside your statutory authority. So now we hear central banks today talking about climate change. How does the governance of the central bank give them freedom to deal with big issues like climate change or all the issues that Mike Carney talked about, values, or the specific issues that the colleague, right, the kind of human resource management. So let's give us your thoughts about governance of the broader issues.
With respect to climate change, climate change affects banks, affects the risk of banks anyway, because the banks have lent money for corporations, to people, for houses, etc. So in a sense, climate change will affect the way these people can pay back their loans if they are affected by the climate change, the way we see it happening at this speed. So as it increases, as climate change increases the risk, on top of the moral issues about climate change and next generation, etc., it's also practical because it affects the risk of banks. So the banks have to take it into account. And then, of course, you can always provide a good example by saying that, you invest only in green bonds in green investments, so investments which take care of ESG
But is
goals.
part of the mandate of the central bank? I mean, you get the very good answer, the standard answer that climate change affects financial stability. But so it's your mandate. But some of the policies, like investing in green technology, is this part of the mandate, or why in green energy generation and not in sequestration, or not in R&D? Now it's becoming like credit rationing, which is a political decision, right?
There has been a lot of discussion about it, even at the ECB. Well, the Fed, for instance, has a broader mandate. The Fed has a mandate which says, okay, stability of pricing, but also employment, full employment, etc. So, you take into account broader issues. In Europe, we have price stability and then secondary financial stability. But then, I suppose financial stability is quite a broad area where you can also take into account things like ECG and moral values or other things as well. So I suppose it should go there, financial stability, or stability generally.
Okay, I think I will express my personal opinion. I think that the governance is the real evil that your poor governance, let's say, or inadequate governance that led to the problems that we had over the last decade or before, even before. I mean, for us, and I think for the whole system, the European Central Bank system and the substructures, to have a proper governance of the institution, it's of paramount importance. That's why I refer to the risks that I mentioned before, to the governance risk, and it has definitely evidence shown that the poor governance has led to the events, the catastrophic events with many institutions going under. And for us at the Central Bank of Cyprus, the prudential supervision also has as foremost target the proper governance on an individual basis, but also on a collective basis. So for us, it's very important, and I think that things are not the same like 10 years ago in terms of governance. I mean, for all institutions, not only the banking institutions, but all the other auxiliary, institutions in the financial markets.
I'm going to ask a question, but don't expect an answer. I'm going to give the question to Marinos and we'll expect an answer. When Marinos talked about governance has been the source of our problems, we very much agree. Was it bad governance of the banking institutions, or was it bad governance of the regulators?
Of the
supervisors. But I'm not expecting an answer. Let's think about it. Mario, please.
It's a similar question. I find it very strange that, for example, in Cyprus, when we talk governance, we talk about the functioning of the board, the control of the board on the chief executive, and so on. And I see a strong government and basically weak boards. For example, England has a separation of there's a chairman and the chief executive of the Bank of England. Two separate roles. The banks are advised to have separate the roles. And then the supervisors are all executive CEOs. The reporting line of the risk committee. I don't see the risk reporting to an independent director in the board. It reports to the CEO. And all these are bad governance. If you recommend to others, this is the standard that you should follow, and then the regulator doesn't follow. And we always we need also to consider the mechanism of appointment of people on the boards of regulatory bodies. How do we appoint? If they are political appointments, it's scary. How do we ensure that they are competent? What's the mechanism? We're setting up now a mechanism to appoint to the semi-public corporations like the electricity authority, telecommunications. The supervisors, all of them, there is executive chairman in competition, executive chairman in securities commission, executive chairman in central bank. Something doesn't seem to work.
To add something, and then maybe Mrs. Eleni-Louri will take it. There was one slide that Marinos showed us from the structure of the central bank of Cyprus. I had the privilege to see on my computer earlier. Beautiful structure, proper governance, except there is one black box on the left, which is the board of directors.
Yes.
That's not connected to anything else. So that's a big gap. So,
No, that's not true. When Maria is here.
well, I mean, well, it's there is no line. It's there is no line. But Mrs.
I think we need another lecture.
Okay.
Well, actually, with respect to the appointments of the boards, etc., I mean, they are, well, first thing, all these I mean, the SSM and the SRB, etc., they are independent authorities, but they are accountable to the European Parliament. I mean, the head of the SRB and the SSM goes to the European Parliament every quarter and has a long presentation, and this is the normal thing. If there is any crisis, it goes much more, or if there is any special session for a special question, it goes much more often. He or she goes much more often.
And the ECB as well.
And the ECB, exactly. So in a sense, they are, I mean, somebody has to appoint them. So it's a political appointment, it's a proposal, a political proposal, which is adopted by the Parliament. So is there anything more democratic than the Parliament chosen in Europe or in a country deciding? The same happens in Greece. It's, a proposal by the Prime Minister for the government, but then it has to be decided by the Parliament. And there is a special committee, and then the governor has to go there, and even the deputy governors, and provide answers and has a long session. So in a sense, and then what's the independence? I mean, the whole idea is you may be politically supported, and the Parliament agrees to your appointment, but then you know that you have only a term, or maximum 2 terms. At the ECB, you have only 1 term, 8 years, and that's it. And this is independence. You know that for these 8 years, this cannot be repeated, and you stay there, and you have to do what you can to fulfill the mandate of the organization. So I cannot see any more democratic way to, and then you go to the Parliament whenever you are asked, and every quarter anyway, on a regular basis, to answer to all the questions the MPs and governments, etc., have. So I don't know. I mean, what could be a more democratic way than the Parliament?
You are answering very well, I think, and also the US system. The governor has to go for a ratification by the government.
The same is everywhere.
But I think Mr. Lambrianides' question, that's not how it works in Cyprus. Okay. Even if we have a presidential system like the US, there is no ratification process. In countries where there is a parliamentarian process, is how you do it in Greece, how you describe it in the ECB. So you are describing what Mr. Cleridis would like to hear us having, and he's pointing out we're not having it. But as you are approaching kind of the exhausting our time, let me take 2 or 3 more questions for the closing round. Just you are going to ask the questions, you have some closing arguments, and we will wrap it up. So, the gentleman, yes.
Yeah. So thank you. I'm Marinos. Right. I very much enjoyed listening to you. I personally, not that you need verification or validation, I have confidence in the European Central Bank, Central Bank of Cyprus. We learned the hard way in Greece and Cyprus, and we evolved, and we're getting better, with better compliance, with better governance. But there's something that really concerns me and worries me. I've had the privilege of giving advice to the presidential palace recently and other people about artificial intelligence. Now, it seems as if I'm going on a tangent. I can assure you I am not. In fact, I noticed from one of the foils from Mr. Lambrianides' presentation, there was a little bit there. We have 111 banks, which the ECB very wisely manages and does other stuff. There was one foil that was under micro-prudential policies, objectives, and it said, and it was in one little piece, under risks was IT. I don't want to put you on the spot, Central Bank, European Central Bank, Greece, Cyprus. Is it being taken seriously? Because all the banks, look what happened to the contagion caused by toxic mortgages in the States. Look what happened to Iceland. 100% GDP, Greece's banking system, theirs was way over, and it caused contagion.
I think, Mr. Andreou, it's a very clear question. Let me add by saying it's a very good question.
10 seconds, can I finish it? Okay. All I want to know is it being looked at seriously? Yes. Because it can bring down the banking system if one bank in Germany suddenly doesn't work anymore because of AI. And I don't mean robots killing us.
Yes, no, absolutely.
Yeah. Thank you.
Let me run out of time. Let me see if there are any more questions in the audience to take them quickly. And one from my students, the last question, figure out what we are going to ask, and we are going to wrap it up.
Marinos, you mentioned before that Greece has a big concentration of market share in the 4 systemic banks, and there's been a push, either a push or it's been allowed by the central bank for a 5th bank to become a pillar. Do you see something similar happening in Cyprus, i.e. a 3rd bank? Because in Cyprus, the 2 banks have 70–75% market share, so if anybody needs another big bank, it's Cyprus, not Greece.
Okay, and one last question, maybe? Marius again? No, let's give the gentleman here.
Panicos Pugilis, Professor of Entrepreneurship, on behalf of what we call stakeholders, small firms, that they don't have access to capital markets for obvious reasons. Who is responsible to promote alternative to bank finance? Who has the responsibility?
Maria, you want to have the last word, but quickly?
My point is, I get a sense that the European regulators and supervisors favor to have big banks. It makes their life easier in supervision, and we see that every time there's a collapse of the bank, just find the big bank, give it to it, and we are picking this in Cyprus. I call them twin towers. In Greece, it's 4 towers.
UBS and Credit Suisse.
Yeah.
Okay, so let's wrap it up. Let's.
If I may start with your comments about the ICT risks, information communication technology, I can assure you that this kind of risk is taken very, very seriously, not only at the local level, at the Central Bank of Cyprus, but also at the European level. At the local level, we have a special section with a special team that conducts on-site inspections about the security systems of the commercial banks. And you very correctly pointed out that once these things happen, it will spread out so quickly that it cannot be it would be irreversible to save the banking stability. So we are very, very careful in conducting these operations, and we think that we are acting quite preemptively, and hopefully we will prevent any bad happening in this regard.
Maybe you want to wrap it up, some of the questions and some
Just
final
maybe
comments.
about this, I mean, being an economist, it's, and being an industrial economist by training, it's, the oligopolistic structure is really bothering me a lot. I mean, I can see the problems. And I can see this idea that once there is a problem, a larger bank absorbs. I mean, the States, we had the same problem with these California banks, etc. If this is what is needed for financial stability, you know, you cannot avoid it. It's when there is a crisis, this will always happen. You see, in Spain, it was Santander, the largest bank or the second largest bank, you know, absorbing Banco Popular. It's you know, this is a recipe, a very old recipe, which is. Otherwise, what can you do? You can create a bridge bank. We did that in Greece. For the second biggest bank we resolved, it was Tachydromicota Post Bank. Nobody was interested. Nobody was interested in absorbing it because they were afraid assets would be much worse than what we thought. So they said maybe these loans are not going to perform, and maybe more loans are not going to perform, so nowhere we don't want to get involved with it. So in this case, you create a bridge bank. But then what's the future of a bridge bank? You appoint the management, and the management has what as a mission? Not to maximize profits and expand you know, the revenue, etc. I mean, just to organize the company so it can be absorbed at a certain point by some other. So even a bridge bank cannot really work substitute the existence of a strong systemic bank who steps in and takes under its wings, you know, the failing bank. So I know, I understand the problem. It has burdened me for very long. It still does, especially when I see the deposit rate I'm getting at the bank and the mortgage rate my son is paying for his home, for his house. So, but when the problem is, when you are in a crisis and you want to ensure financial stability, there isn't much you can do. As I said, bridge bank is an intermediate tool, but even this does not have a longer future. I haven't seen any bridge bank becoming any proper bank afterwards. So yes,
Okay.
I do share your thoughts.
Okay.
So can we also have some comments regarding cryptocurrencies and digital currencies, more digital euros?
I'm not very familiar with the subject. I'm very sorry.
They gave me until 6:30.
I think there is possibilities for custody to the Securities Exchange Commission for cryptocurrencies. We advise our banks to avoid doing any business with cryptocurrencies, entities, and so forth. So I guess the burden falls on the Securities Exchange Commission.
And falls with the
These are the responsible entities.
And the burden falls on the investor and the
Yes,
depositor.
they have to.
Nothing is guaranteed.
I think like a good French restaurant, you should let people go wanting to hear more. So we can still speak more and discuss some more. I would like to leave out with, in my mind, a hanging question. I think we heard people like Mr. Andronikos, and I think he talks on behalf of many of us. We trust the central banks. It's the only game in town with all the problems. Then we hear people like Marinos saying about the democratic process, like how do we get ratification and listen to the new reply. And I think a big question when dealing with the central bank is how does the democratic process make sure that the central banks work for the public good, where the central banks have all the expertise and the monopoly on the information to run their jobs and evaluate their performance. I think this is a very big challenge, which I'm sure the central banks reflect on it. I'm not sure how much our politicians reflect on it, but finding this balance, I think, of this stress, is a major challenge for the next election. So with these closing remarks, I would like to thank all of you for being so attentive. I would like to thank all of our speakers. It was an excellent merge of the two presentations, and congratulate again the Institute for the job. So thank you for